When the stock market crashes, all you have are those dividends for a positive return. I'm starting 2019 with a dividend portfolio that will produce solid returns no matter what happens in the market. I'm also revealing how I pick stocks and my 5 favorite dividend stocks today. We're talking dividend investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your time to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Today's video is a big one, the first in a year-long investing challenge with some of the biggest channels here on YouTube. I and the other YouTubers in the Grow Your Dough Challenge are going to be tracking our portfolios, updating you each month to see who can produce the highest returns. Now, 2018 closed in the red, and this year could be a turning point for investors. So these are going to be some great ideas to help keep your money working for you. In this first video of the challenge, I'll show you how I'm setting up my portfolio for max returns this year. I'm revealing how I pick dividend stocks and my 5 favorite high-yield stocks to start the portfolio. To track my portfolio of stocks, I'm investing $1,000 on M1 Finance. That's a no-fee platform that lets you pick your stocks and automatically invest any new deposits across the group. Unlike some of the other investing apps, M1 doesn't charge a monthly management fee, which is why I'm using it for this no-cost investing strategy. Subscribers in the community here know that I usually recommend a diversified portfolio of growth stocks, dividends, and value stocks, but there are a few reasons why I'm focusing on dividends for the challenge portfolio. This late in the economic cycle, I want to stay away from those growth stocks. These are the companies that have been bid up over the last 10 years on that sales growth. Think companies like Netflix and Facebook. It's not that these can't be good investments, but that growth theme could run face first into the slowing economy, and these are going to be the stocks that get hit the hardest. While I also like that value investing theme, I also want to get that positive cash return from dividends. If the stock market crashes, those dividends are a big part of the return to investors and a great opportunity to buy in the market at the lower prices. We see here that dividends have accounted for between 17 to 73% of the total return to stocks. And in decades with bad crashes like 2000, dividends accounted for almost 100% of the returns. So I'm going to be using some of the same value investing techniques we've seen in the book, The Intelligent Investor, and those used by Warren Buffett, as well as some important dividend metrics to put together a portfolio that not only produces cash flow, but also has solid price appreciation. Now, I spent more than a decade as an equity analyst for venture capital and private clients, and this is a lot of what I did in that work. For each of the dividend stocks I've picked for the portfolio, I created a full cash flow analysis and a report. We won't cover everything there, but what I want to do is take you through the most important measures I use when looking for these stocks. Then I'm going to highlight the first 5 stocks in the portfolio and why they should be in your dividend portfolio. First, I like to do an initial screen of increasing revenue and cash flows from operations. I'll also look for a debt to equity ratio below the industry average, and that total debt is declining for the last couple of years. Now, this is just a basic check on financial health, but make sure that you get started right with companies that are growing organically instead of just through that debt-fueled growth. From this quick screen, I'm going to be looking for stocks that pay a 3% dividend yield or more. Now, the broader market pays about a 1.8% yield, so we're filtering here for stocks with a real commitment to returning shareholder cash. Finally, I'm going to be looking at some qualitative ideas like a competitive advantage of the company has over competitors. I'll be looking at the payout ratio, or how much the company's earnings are paid out as dividends, and dividend safety to make sure that the company can support those payouts. Again, I'll be using M1 Finance to track the portfolio. Since the site doesn't charge any trading fees or commissions, it's the best way to track returns on these stocks. I pick the stocks I want, and M1 automatically invests any cash in the account, including reinvesting any dividends. Besides picking from any stock or fund on the NYSE or NASDAQ, you can also invest in expert portfolios. These portfolios, called pies, either invest on a theme like retirement investing or dividends, or they track money managers like Warren Buffett or Carl Icahn. So my first pick for the dividend portfolio is from a theme that could be one of the biggest opportunities in 2019. I'm talking about Chinese stocks, and specifically the China Life Insurance Company, ticker LFC, with a 3.1% dividend yield. Now, long before the US stock market started crashing last October, Chinese stocks were already tumbling into a bear market over fears of slowing economic growth and the trade war. A lot of these stocks are down 30 or 40% from their highs and trading for half the price multiples of US stocks. Years from now, when we look back on 2019, this could be one of the biggest opportunities, being able to pick up these Chinese dividend stocks at a huge discount. Look, I'm a patriot to my bones, but there's no denying that China is going to be a bigger part of the global economy in the future. You need exposure to that market, exposure to China-based firms that are going to benefit in the way US companies are trying to do, but just can't get there. With that massive drop in Chinese stocks last year, there are two forces that could drive these names higher in 2019. First is just the sheer size and growth in the economy. Even at a slowing rate, China's economy is growing at 6.5%, about 3 times the economic growth in the States. That means the Chinese are adding nearly $900 billion to their economy, almost twice what's being added to the US economy every year. Second here is that because China is a command economy, the government has much more power in controlling the direction of the economy than I think most investors give it credit for. President Xi has tremendous resources from that trade surplus and the economic growth. He's not going to let the economy slow, and he isn't going to let it look like he's losing the trade war. Going into those 2020 elections, President Trump doesn't want a protracted trade war either, and that's going to weigh on the US economy. The odds here are excellent that the two get together and find a solution that makes both look good and resolves that trade war this year. As for China Life, the company controls 19% of the Chinese life insurance market, a country of almost 1.4 billion people. That's more than 4 times the population of the US, but the life insurance market is still undeveloped and penetration is extremely low. Now, I like China Life as a good rebound play in that dividend 2019, but this is definitely one of my top picks for a long-term investment as well. The shares trade for 11.2 times earnings. That's about a 40% discount to the average 18 times earnings on shares of US life insurance. China Life has a payout ratio of just 31%, so plenty of earnings there for growth and dividend sustainability. Our second dividend stock here is a specialty chemicals company, Olin, ticker OLN, and a 4.2% dividend yield. The company is a leader in chlorine derivatives and epoxies, number 1 in many of its markets, but also has this Winchester firearms division that frankly makes very little strategic sense. The Winchester segment accounts for just 10% of sales and 5% of earnings, so certainly not a material driver. I would not be surprised at all if the segment is spun off or sold sometime in the future to allow management to focus on those strategic areas. This could unlock some significant value and push the shares sharply higher. Now, pricing in chemicals has been weak over the last few years, but is turning, and the company could see a turnaround this year. Shares trade for just 10 times earnings, a discount compared to other chemicals companies, and earnings are expected 12% higher over the next year. The payout ratio is just 41% here, so that 4.2% dividend is fairly safe, and there's a lot of room for price appreciation as well. Now, our third dividend stock in our portfolio is another theme I've been following lately and one of the biggest investments in Warren Buffett's portfolio. Banks and community banks specifically have a great opportunity to do well over the next few years on less regulation and those higher long-term rates. So I'm adding Bank OZK, or ticker OZK, with a 3.7% dividend yield. Now, the regional bank has 251 branches, mostly in the Southeast and Texas, and has been named the top performing bank in the country for 8 consecutive years. Just about every measure here, from return on assets to return on tangible equity and non-performing loans, to very important bank measures, all are better than the industry average. The shares trade at a price to book value, which is a better measure for banks versus that price to earnings ratio of just 0.76 times. So shares actually trade for less than the book value of the bank and about a third the average of other banks. Against that valuation, Bank OZK has increased its tangible book value at a 22% annual pace over the last decade. There's a lot of upside here. Not only are the shares trading at a steep discount, so if investors come back to the stock, it could see a 30% return just on trading on that book value. The shares are also going to appreciate as that underlying book value increases. So our next 2 dividend picks are going to be from a recent video on the channel about my favorite dividend stocks that aren't really stocks. We're going to be talking about real estate investment trusts, or REITs, and master limited partnerships, or MLPs. Now, these 2 investments are special types of companies, partnerships in companies that own real estate or energy assets like pipelines and storage. Because of the way they're set up, they pay dividends 2 and 3 times higher than traditional stocks, and they add some excellent diversification to your portfolio. Now, something I detailed in that prior video is the fact that you can't value these REITs and MLPs like you do other stocks. You can't use that price to earnings ratio because earnings just don't make sense in these businesses that have high amounts of depreciation. Now, I walked through those 2 special ways to look at these investments in that other video, and I'm going to link to that in the video description below. So if you're going to invest in these REITs or MLPs, please watch that other video because you need to know how they differ from other stocks. For our 2 picks in the dividend portfolio, we're going first with the REIT and MLP funds here to get that broad exposure to the themes. Now, I'll be adding some solid individual REITs and MLPs later, but wanted to start off with these diversified bets across real estate and energy assets. So first we have the Vanguard Real Estate ETF, or ticker VNQ, which is probably my favorite exchange-traded fund. It holds shares of 187 real estate companies spread across the property types and across the United States. The fund pays a 4.2% dividend yield and has returned 14.7% annually over the last decade. Beyond that solid cash yield and the return, this is a great opportunity to take a little risk out of the stock market and have it in real assets like real estate. The fund has been under pressure over the last couple of years because of those rising interest rates. Obviously with the leverage used in real estate, anytime you have rising rates, that's going to weigh on returns. But we're seeing signs that the Fed is going to slow its rate hikes in 2019, and that could unleash a lot of value in this real estate stock. So we saw the real estate fund in blue here outperforming stocks through 2017 when rates started heading higher. Looking more recently with that market crash, and we're seeing real estate outperform again. Our fifth dividend stock is the Alerian MLP fund, or ticker AMLP. Now this fund holds shares of 25 companies that own energy pipelines, storage, and processing with an average company size just over 11 billion. Just like with the REITs, MLPs pay out most of their profits to dividends, so that means extremely high dividend yields. For the AMLP, that's an 8.5% dividend yield, which is more than 4 times what you get in most dividend stocks. Now that also means that the share price of these companies doesn't increase as much as stocks of companies that hold a little bit more back for growth. You can get some great returns though if you time these investments in MLPs for times when the industry is hurting. Now, MLPs really took it hard in 2014 when oil prices bottomed out and have started to come down again on another bout of weakness in energy. If you look at where they bottomed in February 2016 and then rebounded 47% to end that year, that was double the return on the broader market, and I think we could be in for something similar this year. Now, I'm adding 5 more dividend stocks to the portfolio next month, but we've already got a great portfolio with an average 4.7% dividend yield. That's more than twice the average of the S&P 500, and there is a lot of price appreciation and potential in some of these names. Make sure you subscribe to the channel and follow the portfolio. You can also set up your own dividend portfolio through M1 Finance with the link I'll leave in the video description below. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments. We'll make sure you get an answer in a future video.